Today we're going to discuss an event taking place in the near term. It's the implementation of the Mifid II, the new regulations that will affect the financial market in a big way. For that reason I've invited two guests. It is Henrik Husman, Head of Product Development at Nasdaq and also Head of the Helsinki Stock Exchange, and Daniel Wendin, Head of Algorithmic Trading at SEB. Welcome to the program.
Thank you.
Thank you.
First, and this is a question for Henrik, can you give some background on the Mifid II regulations? What is the rationale from the legislators?
So Mifid II, obviously, it's a huge legislative initiative, and as the name implies, especially for cash equities, it's really a part two to a regulation that was issued already back in 2007, which was the Mifid I package, so to say. So in some respect, Mifid II is about trying to fix some of the issues that were left outstanding with the Mifid I package, and primarily from cash equities point of view, I would perhaps raise the issue and question of transparency. Mifid II is trying to increase the transparency when it comes to equities trading in Europe. As an example, today, even though it might sound somewhat interesting, but today actually no one in Europe has a good feel for exactly how much of equities trading is done across all alternatives. So that's one example of what Mifid II is trying to fix.
What actions are you taking to prepare for Mifid II when it comes to your own business and also to prepare your clients to the new regulations?
I think that Mifid will radically change the liquidity landscape. So for us at SEB, the main challenge currently is to adapt to the new market landscape. That means that we have to spend a lot of time on analyzing where we can find liquidity after Mifid II. It also implies that we have to adjust our algorithms and our execution to make sure that we can trade as efficiently as possible, both for our own internal use and for our clients' use. Then we of course have to comply with all the various aspects of Mifid II. It's, as Henrik said, it's a huge package that we have to comply with.
Yeah.
But also we're trying to spend as much time as possible with our clients, educating them, discussing with them, trying to help them understand Mifid II and the impacts Mifid II will have for them and the business.
And just clients in your case, that is?
In my case, clients mostly mean institutional clients, fund managers, hedge fund managers.
Yeah. What about you, Henrik? What is Nasdaq doing to help your clients?
Yeah, well, there's a lot actually. Most of it is actually compliance related, so things we just have to do to be compliant with the new regulation. But perhaps I'd like to highlight in this discussion the new services that we're introducing to try to help our clients actually deal with the changing landscape. And more specifically, I mean, there are two items in Mifid II impacting the way people can trade. One is so-called trading obligation, which actually means that the about 30 to 40% of all trading today in equities in Europe is done in the OTC space, meaning outside of regulated markets. And now Mifid II is trying to address that space with a term called trading obligation, which means that basically outside of a fairly limited closed list of reasons, you're supposed to actually trade on regulated markets or multilateral trading facilities in the Mifid II world. And that's, like said, it's going to impact about 30 to 40% of all trading in Europe, so that's a big question. And to facilitate that in the exchange space, especially when it comes to larger blocks, we've created a service we call AOD, and that's short for auction on demand, which is the aim is to create a new way to trade equities in the new regulatory environment, where actually dark pool trading as we know it today will be then impacted by another abbreviation called double volume cap, which then again will severely limit the ability of folks to trade using regulated dark pools, which again accounts for about 10% of all trading in Europe. So as the way things are going right now, it seems very clear that early January, dark pool trading in most of also Nordic stocks will actually be banned by ESMA, the European regulator, and that's a quite a disruption to the way people are used to trading, and to that space we've introduced this AOD offering.
Can you please give some explanation on this weighted cap? Because the dark pools are not disappearing, but they have to sort of...
Exactly. So it's a very, to put it bluntly, a fairly unfortunate piece of regulation. I mean, as such, I personally feel that it's good to limit dark pool trading, but the way the regulators in Europe decided to do it, it's less optimal. So these double volume caps, the way it works is that there are two levels, one at 4%, the other at 8%. The 4% looking at dark pool trading on any given venue in any given stock, and then the 8% is looking at the dark pool trading across all venues in any given stock. So in practice, it means that take the Ericsson stock, for example. In January, ESMA will collect data from all venues in Europe, asking everybody to submit how much of trading in Ericsson has been done in total, and then how much of that is done in the dark pool space. And if either the 4% per venue level is reached, or then the 8% across all venues, if either one of these levels is reached, then ESMA will issue a 6 months total ban on trading in the dark pools in Ericsson share for the next 6 months. And this calculation is based on the last 12 months historical data. And so far, I mean, now we're living in mid of September. So far this year, there's been no sign of the markets trying to deal with this, meaning that, for example, in all our index stocks, say in Sweden, the S30 stocks, basically all of them will be actually impacted by the cap in January, meaning that we're facing a situation where 10% of current trading will have to find a new regulatory home, so to say. So it's really a pretty disruptive kind of a setup we're facing in January.
Yes, sure. Yes. Can you say something about the main implications on your part when it comes to Mifid II, you as an exchange operator?
Well, for us as an exchange, obviously, it's the policy aim is it's pretty good in the sense that the one clear aim is to try to get more trading into the lit order books, which is great in the sense that that's where the price formation actually happens. So the more investors actually take part in the lit order book trading, I mean, the better quality price formation we actually have on the stock markets. Because one has to remember that dark pool trading is typically, it's dependent on the visible order book information. So as such, that's a visible policy aim. But then what will exactly happen in January, that still very much remains to be seen, because there are alternatives out there still after the Mifid II regulation is effective. As an example, there is a concept called SI, or systematic internalizer, which will continue to enable and allow banks and brokers to actually facilitate trading against their clients outside of the regulated markets in this SI capacity, with a certain transparency arrangement. So that's for example a big question: exactly how much of this kind of SI trading we'll see then in January. Yeah, and I guess Daniel will give some insight into that.
Yeah, I agree on what Henrik said. The main challenge when it comes to Mifid II is the double volume caps. So I would say when it comes to us sort of analyzing Mifid II from a business concept, business perspective, then the double volume caps is what we spend most of our time on. And as I touched upon before, it's much about making sure that you have access to liquidity on all these new types of liquidity, as Henrik touched upon, whether it be periodic auction markets such as Nasdaq auction demand, systematic internalizers, or all these new types of markets that are popping up to adapt for the situation where dark pool trading is limited due to the double volume caps. Then we also have the other aspects of Mifid II that affects us as a bank quite a lot. For example, reporting. We have to report a lot more under Mifid II as compared to Mifid I. We have to report in areas where we haven't reported before, but we also have to report more extensively in areas where we did report before. And some parts of the regulation also affects the order flow. You have to include a lot more information on the actual orders to the exchanges due to the order record keeping requirements. So I think it's fair to say that the order flow as such will become more complex after Mifid II comes into effect.
And then Henrik, obviously this will change the landscape for equity trading. That means opportunities as well, some obstacles, but how do you see this coming out?
Well, as said, I mean the policy aim is to bring more trading on the regulated markets onto more transparent ways to trade. So that is the policy aim. But again, markets, participants are pretty clever in coming up with alternatives. So what I believe will happen is that the use of this periodic auction kind of trading models, i.e. models that are clearly more transparent, more accessible to all investors compared to current OTC trading, are likely to increase. I also believe that the use of also the closing auction, which already today is it's a pretty significant liquidity event. We have about 20% of all of the daily trading volume actually taking place in the closing auction. So I also believe in potentially the use of that event to increase even further, because I mean that is a already today that is a viable alternative for trading, also with larger sizes with very limited market impact. I mean usually almost always our closing auction actually, the closing price is identical to the last paid price in the lit order book. So that to me tells something about the ability of the closing auction to actually absorb a large amount of liquidity. And then perhaps thirdly, I do believe that the use of what's called a large in scale waiver, which is one of the Mifid II waivers, i.e. arrangements where you're allowed to trade with limited pre-trade transparency. And now I do realize the terms might be cumbersome here, but that's how the regulation is written. But I do believe that the use of this large in scale waiver will actually increase, because as such, as I see it, it's a fairly handy way actually of trading also in larger sizes with very limited market impact, and also then also being able to trade against lit orders in the lit order book, because the way the large in scale order works is that you can actually place a non-displayed, i.e. a hidden order into the normal lit order book, and you get to, for example, choose to trade at the mid price of the bid-ask spreads in the lit order book. And all it takes is your order size to be then large enough, and the size criteria, it's based on the liquidity of the stock, so it starts at 15,000 euros for the most or the less liquid stocks, then going all the way up to 600,000 euros for the most liquid stocks. So, but as I recall, about half of our stocks actually are in the category where all it takes is a order size of say 30,000 euros to be able to utilize this large in scale waiver. So that's another new way to trade that I believe in.
From a sell side perspective, what do you see the biggest changes? Will it be harder or simpler to trade equities post January 3rd?
The biggest changes are the double volume caps and the changing liquidity landscape it will create. So again, for us as a bank, we have to make sure that we have access to all these new types of liquidity sources.
Will it be actually harder to trade?
It will be harder to trade. I do think that, but you can sort of mitigate that risk by making sure that you are having access to all these new types of venues and also interact with them in a smart way. You have to analyze carefully how to interact with these venues to do it in the best possible way.
And for you, Henrik, on the buy side, I mean, the increased transparency requirements on trading, this is intended to limit less sort of transparent trading in dark pools. Is it a good thing to happen? And what's your take on that?
Well, the way it's now done with the double volume cap, I think that's a fairly unfortunate way of dealing with the issue. I would have, for example, rather implemented some kind of a minimum order size to access dark pools. But the overall aim to get more investors to join the price formation process, I mean, that in itself is good, I think. Because, I mean, as said, worst case is that if we start seeing too much of dark pool trading, then the price formation will actually become shakier, and then everybody will be hurt by that. Because, I mean, if your dark pool trading is based on the reference price you get from the lit order book, and then if the lit order book spread starts to be less backed by a good flow of orders, then the whole pricing of equities trading is at risk. So so as such, I think the aim or the goals of Mifid II are certainly well founded.
Anything to add on that?
The double volume caps, they will happen. You can have whatever thoughts you have about that, but they will be there. It's all about adapting.
Yeah, of course.
Yeah, and sorry, I mean, for the buy side, I mean, it's certainly, I mean, it's already complex to trade equities with all the fragmentation around there. And I think with Mifid II, it's not going to get easier, unfortunately.
No.
So I think it's for us at the sell side to help them trade in that new landscape.
Yeah. And in general, the trading volumes, where will we see increased volume and where will we see decreased volume?
Do you want to go first?
Yeah, I can go first. I think we'll see more volume being traded in periodic auction markets. I'm a bit surprised it hasn't kicked off yet, but I'm quite sure it will. We'll definitely see more volume being traded with systematic internalizers. There's new calculations every day on how many systematic internalizers there will be in Europe, but there will be a lot. And we'll also see lots more volume being traded in block markets. In that space, we actually see quite a big increase already when it comes to trading volumes being done. So I think it's these three main categories where you will see the growth going forward.
Yeah. Do you agree, Henrik?
Yes, I do. And then to add to that, I also do believe that the use of just mentioned the large scale waiver is likely to increase, and that's more in the block space as one way to do larger sizes. And then also, as mentioned, the closing auction. I believe that the use of that. It also relates to the, in a way, a non-related or non-Mifid II related trend, which is the increase of passive investing, which is feeding into the closing auction. Increasingly, we start seeing funds who actually are happy to take the closing price as a benchmark, so to say. So, yeah.
I know we have a lot of knowledgeable viewers, but this term systematic internalizer, can you just give a short?
Yeah, I can try. So if you are a systematic internalizer, you're providing capital to the ones trading against you. So it's, for example, a bank providing their own capital, and the clients are then trading against that capital. So there are no resting orders in such a setup. It's only aggressive orders trading against the systematic internalizer.
So you're making sort of an internal market
exactly.
within the bank?
Yes. So it's in that sense quite similar to how the FX markets operate to a large extent.
And of course, since you're an expert in algorithmic trading, I just have to ask, what changes will we see in that related to Mifid II?
I don't think we'll see any sort of major changes when it comes to the algorithms. I think it's much about making sure that the algorithms are having access to all these sources of liquidity, and then to sort of understand the exact details of the various liquidity sources and how to interact with them in the best possible way. So I don't envision any revolutionary changes. It's more like the nitty-gritty details that you have to spend a lot of time on, I would say.
I could just add that as Mifid II also means that all algos need to be actually certified and tested before using them in live. So that should basically help make the markets safer, so to say, for everybody. So,
because today they can trade through another member, for instance, and it's not necessary to have the algo stamp on it. Some marketplaces.
If you're a provider of algorithmic trading in Mifid II, you're required to
but
certify and register your algos. I would say that that's something we already do, but in Mifid II you have to sort of document it and do it in a more formal way.
Difficult question, of course, but will algorithmic trading increase or decrease as a consequence of Mifid II, or what will decide?
Yeah, and my view is that not really Mifid II related, but otherwise looking at, say, the US situation where a huge chunk of all trading is done via algos, I somehow feel that algos will increasingly become available also for retail investors, and hence I do believe that the use of algos, when defined broadly, will increase. And with that I mean that you have to count in then all kinds of execution algos. So I somehow feel that the use of algos is going to increase.
And that's actually a fair point. Mifid II has a quite wide definition of what an algo is. So when we say algorithms in the normal context, it's more like what we call execution algos, like weave up algo. The Mifid context on algo is something that places an order by the use of some kind of logic. So it's a very wide definition.
Finally, if you could sort of mention one difference that will sort of be the difference between Mifid I and Mifid II, looking at the trading landscape. One difference.
Sorry to repeat myself, but the double volume caps, that's the one.
Yes. Okay.
Then I think I will pick this trading obligation that's really impacting the 30 to 40% of all trading in equities today. So that in my book would be the single biggest change actually. The most visible very likely will be the double volume cap, because that's impacting regulated dark pool trading, meaning that it's more visible because it's already regulated, whereas the OTC trading obligation, that's like less transparent very likely. But then again, the huge benefit as I see it come January is that we will finally have full clarity, or at least almost full clarity on exactly how much equities are traded in Europe, thanks to the new transparency requirements. So that I think is likely to be another big visible impact, a positive one.
Right. Well, already now I can invite you for another session here a year from now or something, and then we can see the answer. So very much thank you for coming here. It was interesting, and of course, as I mentioned initially, this is a major topic in the industry, and I know. Can you say how long have you been working on this issue?
I mean, it was a late one for a year. So for me personally, I've spent, let's say, the last 3 years with a very big portion of my working days on Mifid II.
Yeah.
And now I would say it's full time since a year.
Yeah.
Yeah, well, for me, heading the exchange, it's not full time Mifid II, but it started already at least 3 years ago, because there was 1 year delay, and before that we had consultations and all that. So it's been a long process. So as such, it's great now that we only have 3.5 months to go. So
Yes, exactly.
Soon it's implemented.
Yeah, and we're prepared for Mifid III, I guess. Mentally.
Perhaps
not yet.
We'll see.
No.
We'll see.
All right. Thank you very much, and thanks for visiting and watching us.
Thank you.
Thank you.
Thank you.